What if I told you that millions and millions of people have been building wealth secretly and quietly without picking stocks individually, watching the financial news every single day, or trying to predict the next market crash? It sounds too simple to be true, but that is how exactly long-term investors grow their wealth. What if I lose all my money? Or what if I lose everything? Is now really the right time to invest? What if I buy at the wrong moment? You are not alone. Fear keeps more people out of investing than a lack of money ever does. In today's video, I'm going to show you why index funds has become the #1 most trusted form of investment in the world today. How they work, why they are consistently lower risk than buying individual stocks, and how you can start investing confidently, even if you are a complete beginner. By the end of this video, you will understand exactly why successful investors often keep things incredibly simple.
Heart erase, so catch me if I fall.
So let's begin. What is an index fund? Imagine walking into a supermarket. Instead of just buying one apple, you buy an entire basket filled with hundreds of different fruits. If one apple isn't perfect, it hardly affects the whole basket. That's exactly how an index fund works. Instead of buying shares in one company, an index fund owns small pieces of hundreds or even thousands of companies. For example, an S&P 500 index owns companies' shares around 500 of the largest publicly traded companies in America. That means when you invest, you are buying tiny pieces of businesses across technology, healthcare, banking, retail, manufacturing, energy, and so much more. Rather than betting on a single winner, you are investing in the overall economy. That's why index funds are often considered diversified investments. Diversification spreads risk, and spreading risk is one of the smartest things any investor can do. Why people are afraid to invest? Let's be honest, investing can seem scary. You hear stories about the stock market crashes, economic recessions, inflation, interest rates, political uncertainty. Every single day, the news seems to predict another disaster. It's easy to think that the safest place to keep your money is in a bank account. But here's something that many people do not realize. Over long periods, inflation quietly reduces purchasing power. Money sitting in cash can lose value over time if prices rise faster than your savings earn interest. Investing isn't about avoiding every downturn. It's about allowing your money the opportunity to grow over many years. Fear usually comes from uncertainty. The more you understand investing, the less intimidating it becomes. Why are index funds so different? Many beginners think that investing is about finding the next big thing, like Apple, Amazon, Nvidia, before everybody else. But even professional fund managers often struggle to outperform the index fund over long periods of time. Index funds don't try to beat the market, they simply aim to match it. That means lower trading activity, lower management costs, and less guesswork. If one company struggles, others may perform better. As businesses grow, successful companies naturally become larger parts of many market indexes, while weaker companies may shrink in importance or eventually leave the index altogether. Instead of trying to predict winners, you are participating in the long-term performance of many businesses together. The magic of compound growth. Let's talk about one of the most important things about investing: compound growth. Imagine investing regularly. Over time, any investment gains may generate additional gains if they remain invested. This creates a compounding effect. The longer money stays invested, the more time compounding has to work. This is why many experienced investors focus less on trying to time the market and more on staying invested over the long term. Even modest, consistent investing can add up over decades. The key isn't trying to get rich overnight. It's allowing the time to work in your favor. Should you wait for the perfect time? This is probably one of the biggest questions beginners ask. Should I wait until the market drops? Here's the challenge. Nobody consistently knows when the market will drop or rise. Markets can recover before people who are waiting feel confident enough to start investing again. That's one reason why some investors choose to invest a fixed amount every single month via automation. This approach is commonly known as dollar cost averaging. Sometimes you'll buy when prices are high, and sometimes you will buy when prices are low. Over time, this helps reduce the pressure of trying to pick the perfect moment. Instead of guessing, you build a consistent investing habit. For many people, consistency is more valuable than perfect timing. Mistakes new investors make. Let's cover a few common mistakes. First, trying to get rich quickly. Investing is generally looked at as a long-term strategy, not a shortcut to instant wealth. Second, checking your investments every day. Markets naturally move up and down. Short-term volatility is normal. Looking constantly can make typical market fluctuations seem more volatile and dramatic than they actually are. Third, selling during market declines because of fear. Historically, markets have experienced declines as well as recoveries, although past performances does not guarantee future results. Selling after prices fall can lock in losses. Many long-term investors focus on staying disciplined rather than reacting emotionally. Finally, ignoring fees. Small annual fees can add up over many years. One reason why index funds are so popular is that they often have lower fees than actively managed funds. Keeping costs low means more of your money stays invested. Building confidence as an investor. Confidence doesn't come from predicting the future. It comes from having a plan. Know why you're investing, understand your time horizon, diversify your investments, invest consistently, review your progress occasionally instead of obsessing over it daily. Remember that investing is a marathon, not a sprint. Even the world's largest companies have experienced difficult periods. Markets have gone through recessions, financial crisis, wars, pandemics, and economic uncertainty. Yet, over long periods, diversified markets have often shown resilience. Future performance is never guaranteed. Patience has historically rewarded investors who remained disciplined. Now, to close the video, if there is one message that you should remember from today's video, it is this. You don't need to predict the future to become a successful investor. You don't need to find the perfect superstar stock. You don't need to spend hours studying the financial charts every single day. For many people, investing regularly in diversified index funds and staying invested over long periods of time can be a straightforward path to building wealth. The biggest obstacle usually isn't the markets. It's fear. And fear often disappears when knowledge takes its place. If you found this video helpful, give it a like, subscribe to the channel for more money-saving investing tips, and let me know in the comment section, what is your biggest fear about investing? Thanks a lot for watching, and I'll see you in the next video. Cheers.
You sip wine, I drink straight. Don't waste time to my place. I feel my heart erase. So catch me if I